As I'm very happy today to have a chance to join this sharing session because this sharing session I think is very useful, especially for those students. So yeah, I think that we should go straight to the point. Can you all see my slide?
Yes, yes,
Yes,
Okay, okay.
yes, Mr. Kang, it is clear. Yeah.
Okay, so for the first page, it's about me, but okay, let's keep it. But Manahan just introduced me. So just a quick note about today course. I think that today is not about I'm not gonna spend time, waste your time to talk about the meaning of some financial ratio or the formula, but I want to spend time to share the point of view, how to see, how to analyze the financial statement from the point of view of someone outside the organization, not from an insider. Like in finance world, there will be financial guy, accounting, and those are the insider. And then right now we are outsider. We just know the company through their financial statement. So how can we read the statement? And more particular, I'm gonna bring the view as an investor, how we can use the financial statement, how to screen the stock to find the stock that they want to buy and make investment decision. That is the today goal of my sharing. Okay, so my sharing will be sorry about my English. It has been like very long time I haven't used English. So it may not be not my pronunciation may not be good or not speak fluent, but I hope that you can understand. So the first thing I want to say about the financial statement for the most common misunderstanding is that people often think profit is everything. Like the first thing a person wanna look when they look at the financial statement is that they go to the income statement and see what is the net income of the company, how much money they made. Of course, I must say that profit is important, but it's not the only thing matter. There are so many things also matter for company to see, not just the profit. For example, right now I'm gonna show you a very case. I think I must be familiar with all of us. This is the financial statement of Vingroup. Yeah, the ticker is VIC, the biggest corporate in Vietnam. You can see the income statement of Vingroup. And if we look through, sorry, and if we look through on the bottom line, there will be the profit after tax. And over the last 6 years, they have almost 5 years profits. Only in 2021, they have record a loss of 7,500 billion. So in paper, the company is still good. They're making money, and we see that they expand their business. They close some of their business line, but they expand in EV. They expand in real estate. But like I said, if we look only in the profit, that would be not enough. One more thing that we often say is that we have to focus on the quality of earning. Does that earning come from the core business? Does that earning come from does that earning come with real cash flow? Some companies they record earning, but actually it's just a booking. The earning doesn't come with cash flow. That means the company has earning, but they have no money to pay for their expense. So that earning is not good. And we can see one of the things we can see the quality of earning is that we look at the cash flow. A good business model should have good earning, and this earning should come with a good cash flow. And we can see that like in case of Vingroup, you can see that we can see the CFO is a 4 column of yellow. Oh, sorry, I have, when I took the financial statement, I forgot to change to English. Hope that you all understand.
It's all right,
Fine,
Mr.
Mr.
Kang.
Kang,
Yes,
fine.
yes. I also realized that, but we are talking about numbers. Should be okay.
Okay, so we have the CFO. It means the cash flow from operation.
Finance,
You can,
CFO.
yeah.
Yeah.
And we can see that like for Vingroup, in the last 5 years, like from 2020 to 2024, they have negative cash flow in 2 years. In 2021 and 2023, with the total negative, it's like 34,000, around that. And if we combine with the other 3 positive years, it's 2020, 2022, and 2024, we can see that like they have like they still have a positive cash flow, but the cash flow is almost like very minimal. It's just a few 100 billion in terms of their size, and most of their how they can balance their finance. As we can see, they have a quite huge demand for their CFI. It means cash flow for investing, and they have to realize on the CFF. And most of that they come from, you can see each year, the Vingroup had to realize at least from 10,000 to 48,000 billion each year. So it's a huge amount of money need to be pumping the business to survive. So that's why I said like the profits is not everything we should love. Another case is SHI Sunha Group. This one may not familiar with Malahan, but for us, I think we are all familiar. They produce water tank, the enough water tank on the top of our ceiling. So this one you can see it's a cash flow from operation statement. You can see the first yellow line is the profit before tax. It clearly seen that they have quite steady profit, more than 100, at least 100 something billion each year. But if we look at their cash flow, you can see that their cash flow is almost negative. They have only 3 years, 2020, 2023, and 24, they have positive cash flow. With the total amount, I think is like maybe nearly 500, but other 3 years negative, they have negative like 600 billion. So the point of view is that with that kind of company, they can record profit, but after all the money come from something else. Like for this kind of company, we can clearly see that like they can still record profit and they have increasing revenue, but the point is that their working capital is increasing. I must say like crazy, especially the account receivable. You can see the account receivable is the first white line over there. It's like almost negative 7 in the 2024. It's like 900 something, 900 billion. It's almost like 9 times, no, 6 times than the profit. It means that for the company, we can see that I think it's a red flag for an investor like me to see that kind of statement. It shows that like the company may have some trouble with their distributor. Maybe their distributor the one who take the real profit and real cash flow from the business, not us as the shareholder of the mother company. Because for those kind of company with such kind of cash flow like that, they don't have money to pay dividend or something because all the money comes to the account receivable. So that's one thing. Okay, so this is the thing that I think that's the most important, the most common mistakes everybody face. Me too. I was in the past when I look at the financial statement, I always look at the income statement and see okay, how much money the company makes, what is the EPS. But the furthermore I dig in, I think that there will be several misunderstanding. And the second misunderstanding, I think, is we often try to see like to find an optimal formula for all the firm. Like all of us have, both you have learned about some ratio, average ratio, quick ratio, or solvency ratio. So what would be the most optimal leverage? How much money a company should borrow to increase the return on equity? Or how much the money the company should remain to stay solvent? So that is the key question. How much? How many? And at the beginning, I think as you can see, like the textbook gonna say the quick ratio should be at least more than 1. The debt ratio should be the debt should be no more 3 times than the equity. There's some of rule like that, but is it actually true? Of course, it has been written in the textbook. It must be correct. But like, if we say that this is the optimal, I don't think so. Let's say that we have gonna dig in some example. Here is a financial ratio of Vinamilk. Is I think all of us had know. Maybe Malahan, you may know. It's a biggest dairy producer in Vietnam.
Yes, Mr. Kang, I'm aware about that, and I'm also a favorite customer for Vinamilk.
So we will look at this and we can see I have brought some highlight for me to remember what to say here. Vinamilk is the best safe in terms of solvency risk. And you can see that if we look at some kind of ratio, current ratio, we have Vinamilk has 2 times, quick ratio 1.6. And when you compare to another one is SPG, It's a biggest steel producer in Vietnam also. You can see that their ratio is much in terms of solvency is like worse. The current ratio is at 1.2 and quick ratio is just 0.4. So it's a warning from the textbook. It's a violation. Too many current debt and lack of current assets. And another example is MWG is a mobile war. It's a big distribution of mobile phone, electronic device in Vietnam also. You can see that the current ratio and quick ratio is actually better, but less than Vinamilk. So is it true that Vinamilk is the one safe, the most safe? Of course, by looking at this, I think that we can clearly have the conclusion like that. But can we say that this 1.6 is optimal? I don't think so. Like if we go to like FPG, we can see that their ratio, they have stayed around this for like very long. And another thing is asset turnover. The asset turnover is also something like that. The more asset turnover, the more efficient the company is operating. Yeah, in theoretical. And we can see that Vinamilk has asset turnover of 1.1. You can see the top right here. And SPG is just 1.7. But the mobile watch, they have 2.1. Yeah, very impressive. So what are we gonna use with that? How we can find out what is optimal and how do we can compare with from each firm and to the other firm. My lesson is that no, you cannot compare. Textbook is this textbook. For the case of HPG, you can see the quick ratio. Maybe you can see like 1.4 is dangerous. Of course, I think it's, if we look at them in the past, they used to be like 0.5 or 0.6. Now they come down to 0.4. Oh, that is really the warning because yeah, their liquidity has dropped down. But if we can say that with 0.4 of quick ratio SPG and we compare to Vinamilk, they have 1.4. So we can conclude, if we can conclude that SPG has the risk of default 3 times to Vinamilk, it's not something like that. And the reason for that is going to be in the next slide. Next slide will be the misunderstanding 3 when we apply the same shoe for everyone, because each company will have a unique characteristic depend on the business model, depend on what they do. Like for example, we can see that in ICU, the 3 example above. I don't want to mention too many company. In this 3 company, you can see that first asset turnover, HPG has the lowest asset turnover. They have only 0.7 times per year. And of course, Mobile World has a highest 2.1. So we cannot conclude that Mobile World is much better in terms of utilized asset than SPG. It's too soon for us to conclude like that. When you listen, study textbook, because you have to understand, first thing is that they working in two different industry. HPG is a steel producer, so they have to invest a lot on fixed assets, on capex. So it means their asset will be much bigger. And for some industry like steel production, you have to invest a lot. And then each year you're gonna have depreciation. So the consequence is that their asset turnover would be lower. But for some company, trading company like Mobile World, they don't produce anything. They just buy goods from the producer and then resell it. So they don't have much fixed assets. They don't have to invest much on fixed assets. They have only some store, but the store, they don't even have to own the land. They rent the store. So their asset is very low. That's why you can see asset turnover Mobile World is much higher than HBG. So don't apply the same shoe on everyone. Another thing is that you can see maybe inventory turnover. Inventory turnover, of course, Vinamilk is gonna be the highest with 6.1. So 6 times a year. And HPG is 3 times, yeah. So the inventory is take about 4 months to sell. And Mobile was take 4.8 times. So that's very, I think like we cannot compare because Vinamilk is a dairy product. So it expiration of date of their product will be like less than the steel, of course, less than the cell phone. So it has to increase the inventory turnover. So that is the lesson for us to looking at that mistake is that we don't compare all the company the same. And the second thing is that when we look at a company, we should know and digger in their business model. And each of the company in each industry will have some key ratio. Like for example, if I want to compare Mobile World, I want compare it with in order to like analyze their financial statement, I won't compare it to SPG. I will compare it with FRT. It's a FPT shop. Yeah, also another electronic device reseller. And we can see that like they will have a quite the same ratio. Asset turnover, Mobile was 2.1. This one they have FRT, they have 2.8. So FRT has a little bit better in asset turnover. But for trading company, I don't care much about the asset turnover. Actually, I will looking at their inventory turnover because a trading company, if you look at their financial statement, most of their assets rely on inventory because all they do is buying gold and resell it. So I will care like how many days a good stay in your store, and we can see FRT is 3.5 and Mobile World is 4.8. So I think this is one of the reasons Mobile World is first the biggest market share and FRT is the second. You can see that through no need to through the income statement, you can see that even in the ratio. And also, like, it's not only about some asset turnover. You have to look at, other thing in details, like what I said before, like what is the optimal leverage ratio? Yeah, it's a key question because for us, as an investor, I always look for a company with high ROE, return on equity. But ROE is depend as a DuPont analyst. You may know or may not know, but ROE is depend on one of the component to determine ROE is the leverage. You can increase the return on equity by increasing leverage. But using leverage here sometimes may be dangerous. So how much? If you don't use leverage, this could be lower your return. So we can look at like the ratio total debt and equity. This is SPG. Okay, looking at SPG. You can see that like for SPG, their long-term debt on equity is like 23%, and total debt to total capital is 42. So they have debt to equity is, I think, 40, 60. But we look at MWG Mobile World, we can see that they have long-term debt to capital 0%, but they have total debt to total capital is almost 90%. So it's a 50-50 for MWG. So is it true that like Mobile World is dangerous in terms of solvency than HPG? Yeah, they have higher debt ratio. But why they don't use long-term debt? That is something you can see clearly. One more thing is that like if we look at another thing, like for trading company like Mobile World, they have lower margin. So how can a trading company make profits? They make profit by increasing the inventory turnover and the kind of inventory, the purchase of inventory will be sponsored by debt, and they are all short-term debt because like with the inventory turnover of nearly 5 times a year, it's like more than 2 months. Yeah, if I the owner, I wanna use short-term debt. But why Mobile World don't use long-term debt? Because of course the short-term debt will be cheaper than the long-term debt. And the second one is that for Mobile World, they don't have the asset to use as a collateral for long-term debt. They don't own physical assets much. So that is the key point. And for SPG, it's another thing because SPG, they have the factory. So they will have to rely on the long-term debt. But the long-term debt could be a serious problem, but it could be more stable in terms of interest. So during the in some year when the interest come up rapidly, so some kind of like company rely on short-term financing like Mobile World will be affected. That is something we should know by looking at this ratio. You can see like, oh, this one is focus on debt. How much debt? Is it long term or short term? Why? And all has to be linked to their business model. And yeah, for Vinamilk, you can see another case. So Vinamilk. Yeah, Vinamilk. You can see they also have no debt at all, no long-term debt. Even they have factory, they don't use debt. They still have some debt. Debt to capital is like 20%, so it's 2x. But they have like quite a lot of current ratio, 2x, 2x time of 2x time of current ratio and 1.6 time of quick ratio. But why? Why they have to use this debt? You can see that like if we look at their financial statement, and you can see that like they have quite a lot of money. They have 2024 they have like nearly 2,200 billion in cash and 23,000 billion in saving account. So in total they have like nearly $1 billion in cash and cash equivalent. But they still remain, you can see that a short-term debt around 9 billion. So why they should do that? They have quite a lot of money, cash, but they still maintain the debt, the short-term debt. That's because they want to increase their ROE. And for some company like Vinamilk, you can see that they have increasing inventory turnover and their account receivable is also very quick in terms of industry standard. It's only nearly 4.5 times a year. So yeah, it's like more than 2 months. They got the money for paid for their goods. So for Vinamilk, they try to utilize their cash. You can see their investment, short-term investment here is a saving. They lock into long-term saving to get a high interest rate, and then they keep borrowing from bank for short-term rate at a much lower interest rate. That's why they have financial income. Yeah, and they can make money from there. So for all of you guys listen here, I think that maybe some of you 24, 25, some of you gonna be financial officer someday. You're gonna have to think about this, how to make money, but from money. And okay, I think that's quite enough for academic thing. Now my next part is move to another thing like some misunderstanding. One of the most misunderstanding I hear most is that so many people say that financial statement is not important. Common sense is that they can say, oh, Vietnamese data are easily manipulated. And as an owner, I can, or maybe somebody can smooth the earning, even they can fake the bank balance, can fake the accounting entries. So all of the financial statement are BS. Don't, I don't read it. So is it true? I must say that from my point of view, I couldn't deny this. It's that happen, especially in private firm or some but like in everything, if you do something, they will leave trace. And so trace, if we look at the financial statement carefully, it will give us some red flag. And like I said, why in the beginning I show you the example of VIC, Vingroup. You can say Vingroup, for most of the people say in Vietnam, just know Vingroup very big, too big to fail. And yeah, HHI, yeah, a small one, but I think popular. But looking at their financial statement, you can see that, yeah, here's a stock price. You can see in the 5 years of earning, the stock price of SSI is almost no increasing at all. And so for Vingroup, except the recent high in the last 2 months from 2021 to 2025, it's all go down. It's be like nearly more than a half. So from my point of view as an investor, I think like we shouldn't think like FX is not important, but we should also think of the fact that all of the things I list here is happened. But yeah, you cannot deny, but you should know that it happens at some kind of degree in real life. And the last thing I want to say is that we shouldn't only focus on the 3 major statements. Of course, in financial statement, we combine with the balance sheet, the income statement, and the cash flow. And most of people only look at the 3 and don't read the rest, and it's gonna be a big mistake, because a very important part of the financial statement is a footnote. The footnotes can bring us much more detail about everything of the financial statement, including the breakdown details. And there one small thing here I want to say, like the secret often lie on the other. Like we can see the financial statement of Bamboo Capital. Yeah, I chose this one on purpose because it has some kind of legal trouble in last years. And you can see that, but I chose the 2023. It's been like it happened before the thing happened. You can see that even a company when it's work normally, but you can see that like we often say that their financial statement is stinky. I can smell the frost by my voice. You can see like if they have total assets is 42,000 billion. But we can look at that, you can see that they have receivable almost like 35% of their asset is receivable. And most of that come from the other receivable. So if we don't look at the footnote, you couldn't see that the 8,000 come from who. And in terms of the company, when they make the financial statement, the other payable, other receivable, other everything. That's how the secret often lie down. And if we look at the footnote, you can see that they have a lot of receivable for short-term loan for some individual, don't know who. It's quite a large amount, and some kind of receivable from for business cooperation contract, BCC, with a lot of company with a large amount, and we don't know what is that. They don't disclose. But for financial statements, with that amount of money in terms of asset, if they don't give a quite clear disclosure, it's another red flag. So yeah, my conclusion is that read all the page of the financial statement and think of like what is important and what is important with the business. And the last thing I want to share is that the limitation of the financial statement. And the first one I already said that they can be manipulated at some degree, and the biggest limitation is that they are only historical data. That means that the financial statement only can describe the how the business is doing and what the company was at a moment in the past. But it doesn't mean that the financial statement can give you a guideline what will happen, what's the company will present, will do in the future. And as an outside investor, we also face some difficult, like maybe we can couldn't access to the financial statement, maybe because of their private company. A lot of company in Vietnam, they have double accounting book, one for the tax and one for them. And like I said, from the above part, like for some company, in order to compare, you should compare the company with its peer in the same industry. So that is the limitation for financial statement analysis, because for some company, you wouldn't find any peers at all. Like for Vingroup, how can we find another company that's big in Vietnam who also in real estate and producing EV? There's no one else. So this is also the limitation when we don't have something to compare. Okay, I think that's all I want to share. I hope that it should be enough.
Thank you. Thank you very
Oh,
much,
wow,
Mr.
it's
Kang.
so interesting, Mr. Kang.
Yes, yes.
Lots of good.
Interesting. Yes.
Now, I have any questions from students, and you can give.
Okay. All right, Mr. Kang. Yes, here. As we speak, we got a question from the students you can see on the screen there. And also later, I also have a question for you. So this question is from Ayn. She's asking, I think you can see on the screen there, right? And may I ask you how you calculate or from what sources of information for the industry medians, like return on asset, return on equity in specific industry. And for market performance, we use trend analysis of stock performance, or what are the key steps in market performance analysis that you use as an expert? You have to turn on the mic, Mr. Kang, your mic. Okay, yes.
I forgot that. First, about the sort of information for industrial median. Yeah, we can for public companies, you can easily find their financial data from public sources, like maybe cafe app, stuff. Yeah, it's all free. You can find financial data, all public stuff in the market. But for me, I use some kind of Bloomberg or maybe Router. It's much easier. And industrial median, in order to make the industrial median, you can calculate all the sample and then you make the median. It's the one thing. And the other thing is that you can use some best sources like Bloomberg to find maybe the competitor peers maybe in the domestic or international, they're gonna provide you a sample, and you can customize the sample later if you want. How many company used to calculate? Actually, I'm gonna one as much as possible, but one more thing I haven't mentioned in my presentation is that even in a company in the same industry, you should compare even in the same size. Like a retail company with 1,000 billion revenue is much different with mobile world. Yeah, several thousand billion revenue. So the differences in term of size is something also limits the sample. So I would be happy to have like maybe five sample of company, but the five should be fit with the company I want to compare.
Thank you, Mr. Kang, for your reply there. Okay, and this one is a question from me, because you share about that we cannot put every company in the same shoes, because they have different criteria and they have different characteristics, right? So in your profession, right, I mean, how much do you acquire knowledge about the industry? Because each industry characteristic is different, and that can influence about what ratio is more significant than the other.
That's a very interesting question because it is exactly what I do for living. Like I don't know, but like for me, when I'm right now I'm the head of research at the security company, so my job is like making research about how the company or how the business of the company is going to perform next years or the next few years. So in order to doing that, I have to know like at least the past. I said so studying the financial statement EMS. Like I said, FS bring us the picture of the past. So after like reading the FS the reports of the company of a company I research on in any peer, and gradually I think I will know what is important. And you also have to like have the interview with other. I often ask the portfolio policy. You have to, in order to make a research about the company, you have to ask for their supplier, for their customer, and also their competitor and the company itself. So if you gather all four sources, I think you're gonna have the bigger understanding of how the company is operating and what should be the advantage of one company over the other and what is the weakness. And those things, the kind of weakness and strength gradually please show in the FS.
Thank you, Mr. Kang. Yeah. So as we speak, a question came up from a student here. I try to understand this question. I think you can see from the input for financial ratios, mostly the earnings. What is a low quality transitory earnings component I should remove? Hello, Ka. Can you clarify your question? I don't actually get here. Can you please turn on your mic and ask Mr. Kang? No reply. Transitory earnings. I don't get that transitory earning. Or he doesn't have a mic then. Okay. All right. So no problem.
See, Mr. Kang can see what the point you can respond to that at all? From your point of view to the student's question.
Actually, I don't get the
Oh.
transitory earning, but
Okay.
okay, I'm gonna talk more about low quality earning. From my side, you can see like the quality of earning I mentioned is one of the things that I think is the most important. So the first thing is that the quality of earning is that when, for me, from my point of view, rely on two things. The first thing that once the earning, the company report in the financial statement, the income statement, yeah, come with the cash flow. That's what I mentioned in the presentation. This you can easily see by, you can look at the CFO. But actually, some firm even like they can make it up between cash flow from investing and cash flow from operation. But yeah, that's too complicated. But the other thing is that we should answer the second question is that if the company with earning with cash flow, but does this earning belong to the shareholder? That is for me, as a investor. So we, as minority shareholder, I gonna concern there's two things more in terms of earning of the company.
I guess the question seems to be like if the components of earning include the ones that are not earnings that are repetitive and majority and I mean primary earning over time, then should we remove that component for comparison? For example, this year certainly a company has a increase in revenue significantly, but that increase has attributable to something just one-off happening, or just happening because of some specific circumstances that will not repeat next year. Should we remove that from our analysis, and what kind of such earnings that we should remove? That is what the point the student want to ask in addition to what you just mentioned. Yeah, but I guess.
So that is about the abnormal earning and non-current earning, right?
Yes. Thank you, Mr.
Actually,
Kang.
like,
Okay.
I think that from my experience, I always deduct that in my analysis because we couldn't expect that will happen in the future soon.
I see. Okay, Mr. Kang, while we are waiting for the students' questions to pop up on the screen here, okay, and then is it true or not that the certain companies, especially the companies which has a stable cash flow, so this kind of company, the company that has these characteristics, they can afford to have like a lower current ratio and a quick ratio, and at the same time they can also afford to have high degree of debt in their balance sheet because they have the stable cash flow compared to the company in which their cash flow is fluctuating like that. The mic, Mr. Kang, the mic. Okay. Yes. Okay.
I think that we, if we're looking at the kind of like MWG, you can see quite clearly. For MWGs, they have quite a lot of cash, but they always maintain the quick ratio of 1, or maybe sometime in the past. And if you can see, can you see my slide? Okay. And you can see MWG in the past, they maintain the quick ratio is around like 0.2 or 0.5 times. So it's quite low for a trading company because like you said, they maintain low, they have cash, but they maintain quite a lot of debt. They try to explore the gap between the lending rate and the saving rate.
Thank you,
So,
Mr. Kang. Maybe my question, can I have a question? And maybe move with the last question because we run out of time. Uh, it's very interesting. A lot of information I got. I found it very interesting, and I just want you to please extrapolate a bit further on the comparison within an industry. You know, you explained very clearly about comparison across industry, like the Vietnam milk in the dairy industry and the steel industry. But then what about within an industry? When we have different companies in an industry, should students just compare and be sure that if one company has a higher ratio, then it's better, or should they dig further and to find out that maybe the business models are not compatible, or why this company may be looking a bit lower in terms of ratio, but they are not really showing poor performance and so on. Can you just extrapolate a bit more for our students?
oh, it's a hard question because like we often say something present on the financial statement is something has already done. So it not gonna reflect any change the company is making. So for some company, as you can see clearly, like let's say I gonna choose SPG. You can see SPG they have you can see like their asset turnover is getting low in recent years because they gonna have invest a lot of capex. They open up a new factory, and for some kind of like company, there will be some time their ratio will be like less favorable than peers, but it may reflect something is happening with them. Maybe it's true that they are really is going to be down, or they just having something to change, like a new capex or new projects or
So it means the student will have to go further, right, into, oops, Mr. Kang has lost the connection or something.
I think we lost him to yeah. We lost him at 3:59.
Yeah, I think this question I raised for especially our AOS student, where you would have to do the financial statement analysis, right? Even if you compare companies with peers or with industry medians, you should also need to dig further into the company business to see, if the ratios reflect poor, better quality, or if it's because of the changes in the model or the business activity and so on, right? Don't just come straight into the conclusion. You need to really take into account the business information for your analysis. Okay. I don't know, Malihan, Mr. Kang.
I think I'm not sure because I think it's like this.
Problem with connection.
Yes, because maybe he could not re-enter because the meeting is booked until 4 p.m. No problem. I think we can clarify with him later.
Oh, maybe we kicked him out.
Yes.
Should have a big, So
yes.
can you help us?
That is possibly the case. I'm not sure, but that could be possible.
Could be that he's kicked out of the meeting.
Yes.
Anyway,
okay,
at least it's finished.
I think if that's the case, I think we shall wrap up this
he
session.
had problem with connection.
Okay,
he had problem with connection, not because of his kicked out.
Yes.
He will be back soon, he said.
Yes.
But then just give 1 or 2 minutes to see if he can come back so we can say
I think that's
goodbye and
better.
thank him
Yes.
for that. But
because-
student, I hope you can learn. We hope you can learn a lot from the guest today. Okay.
Actually, what I meant
kind of-
earlier, Tui, is that I don't know whether he has the issue to come back or not, you see, because when we book the session, right, It is until 4, but now the time is 4:01. So I'm not
Okay.
sure can he
So maybe we
enter
will,
back.
yeah.
So we just wait for a while.
No, he can enter still after the team
Okay,
doesn't
okay.
restrict it,
Okay.
restrict,
Okay,
ju-
that's good.
oh,
That's
does it
good.
come? Yeah,
Okay, I
team
think
doesn't
probably
restrict people joining again after the
Okay.
time. I think
I
it's
think
fine.
I
It's
saw
just a connection in the company. I think
Mm,
Miss Pearl has been saying that
mm.
from the
And
company.
I saw someone's coming here, Tui, which is written external here. Do you see that on the
That is Miss Pearl. She's from she's from Pai
uh-huh.
Chui, I think.
Okay,
Hello,
I
Miss
think
Pearl.
because the mic is off. Then can you tell her to turn on the mic, Tui?
Miss Pearl, can you if you would like to speak something, can you just turn on your mic? We're waiting for Mr. Kang to say goodbye and thank him.
Oh,
Okay. No problem, Mr.
okay,
He's
okay.
coming back. Yeah.
Okay.
Great. Yeah, okay. We just
admit it.
need to conclude the session now, Malihan. Can you?
Okay, sure.
Sorry, I got
Alright.
some technical problem.
No problem, Mr. Kang. Mr. Kang, thank you very much. Yeah, thank you very much for your thoughts, for sharing your thoughts about the financial statement analysis to our students. It was a
I
very
think he's out again. He's not in. He's in. He's Kang in. Mr. Kang in.
okay.
Oh, here,
Okay.
here you are. Thank you. We're waiting for you to come back to say goodbye and thank you for the session. Malihan, over to you. And
Okay, so we wrap up the session, right, Tui? Okay. All right, students, thank you very much for your participation today and hope that you benefit a lot from Mr. Kang's speech. We only have a small glitch, but that small glitch was already towards the end, you see, but you have benefited lots from what Mr. Kang has shared earlier. And then so try your best while you are reading text about the financial statement analysis. Okay, at the same time, try to connect this to the what's happening in the real life. So thank you, everyone. I think that's it.
and thank you, Mr. Kang, for very valuable session. We look forward to be able to working with you again sometimes in the future. Thank you very much. It's so useful. Thank you.
Okay. All right, I will turn off the recording now.
See
Okay.
you.
All right. Yes. Okay. Goodbye, everyone.
you.
Yeah.
Goodbye.
Yes. Goodbye, Mr. Kang. Goodbye, everyone.
Great.